One thing I really liked about this thought was it says here, often these items purchased with borrowed money without giving any thought to providing for our future needs. So remember, when you're buying things on credit, you're committing your future income to buy the things that you're getting right now. So now, then in the future, you can't afford to buy the things you might need then because you're still paying for the things that you bought like a month ago. So it's just really important that you don't commit your future income. If you don't have the money to pay it, then don't get it.
Okay, let's talk about what we're going to be doing today. How many people know what their credit score is? Raise your hand. How many people have looked at your credit report? How many people have never heard of any of those things? How many people know what your interest rate you're paying is on your credit card? 2, 3 or 4. Today we're going to be talking about a lot of those things. So by the end of today, each of you will understand each of those things. You'll have pulled a credit report. You'll have pulled a credit score. Some of you may not have a credit report. As long as you go through the efforts and they say, okay, there's no information, you'll get full credit for this, both for the score and the credit. So what is your vision for your credit plan? What are your goals? Now, as credit users, there's really 3 types. You're either a credit user, which means you pay interest every month. You're a convenience user, which means you pay it off every month, or you both. You do some for convenience and some for credit. So the other thing we want you to do is you need to get a copy of your credit report. You need to review it and make sure that it's correct. And then you also need to get a copy of get your credit score. And we'll show you a number of ways to do that. You can do it for free. If anything today requires you to input a credit card number, you're in the wrong place. So everything we can do here, we'll do for free.
So this is about a guy, it's a funny commercial. They're trying to get you to borrow equity out of your home, and we'll talk about that. But it's a funny commercial about this guy who's in debt, a lot of debt. And he's acting like he's happy about it, but it's not good.
So let me tell you what a home equity loan is. A lot of times people would go into debt. And so a home equity loan or a home equity line of credit allows people to borrow against the equity in their home. So if your home is worth $200,000, you still owe $100,000 on. Your equity is $200,000 minus $100 or $100,000. The downside on this is this research has found that like 80% of people who use a home equity loan to pay off their credit cards, in 3 years, they're back to where they were in debt because their habits haven't changed. They haven't.
So then they also have the extra mortgage and the debt.
Are there people that are so much in debt they're oblivious to what they're paying? And again, this is nice if you've got equity in your home, but what percent of people actually have equity in their homes? So it helps us. So someone define what is credit for us.
Well, and it's not a good idea to borrow on the equity in your home because you're just borrowing more money.
Yeah, you're just borrowing more money.
And then you're going to make your mortgage go longer.
Yeah.
If
you default, you lose your house.
Good job.
So what is credit? Someone define credit for me.
Future money.
Future money. Other thoughts? Yeah. Trust.
Okay,
it really
good.
is. It's actually both of those things. So credit is trust. It allows, go ahead.
No, you go.
It allows one party to borrow money from another with a promise to repay the money with interest.
But it's also debt. So debt, it commits future income against today's purchase. It's not cash.
It's not your money. It's money they're willing to give you at a very high rate of interest if you're silly enough to take it. And it's bondage.
And it's hard to pay back.
Yeah. It's a lot easier to borrow money than it is to pay back, and we'll spend some time on Monday. Principles of using credit wisely. Understand the key areas of credit. Know where you are financially. The good news is you guys have already done a balance sheet, an income statement, and a budget. So you know where you are. And so that's the good news. So what you want to do is you want to keep your credit score high for other things. And it's interesting, a high credit score not only helps you with lending products, but did you know your insurance Your car insurance also looks at your credit score. If you've got a low credit score, what they found is people with high credit scores make a lot fewer claims. So if you have a high credit score, they'll charge you less on your insurance and other things too. So be wise when you're using credit. What have we been counseled? 3 things it's okay to go into debt for: a modest home, a modest education, and I heard one apostle say, and perhaps a first car. But what does that say for car 2 and car 3 and car 4? And then create your credit plan and review your score and credit reports annually. Now, that was good advice 5 years ago. Now I can actually look at my credit score on my phone every month or every week if I want. So we're not just trying to be a wise user of credit. I understand my credit history, use it to my advantage by keeping my credit score high, so I can get the lowest cost on needed credit products, so we can eliminate interest costs and save money to accomplish my personal mission and my individual and family vision and goals. That's what we want to do. Okay, are there lots of different types of credit cards? Yeah. There's kind of a standard card. My wife and I have a business card. It's a reward card, but because businesses, we have higher limits, and so we can get more miles. So we do a lot of our next flight home will be on mileage, a mileage card here.
Pesos.
Then your secured cards. Sometimes people don't have enough credit to get a card. And so what they can do is you can get a secured credit card with the bank where you put money into the card, and then you use it just like you would a credit card, and as soon as the money's gone away, you can't use it anymore. The interesting thing is the credit reporting agencies can't tell the difference between a secured card and a regular card. So what happens is after you've got a year or 2 of experience there on that, then it's a lot easier to get another card. And then debit cards, we're all familiar with those. So just things, important questions you'd ask here on the side.
So these are papers that you put at the back of your credit tab.
Credit section. Again, it's resources. I hope you realize we're trying to give you resources. So later on, when you look back over what you've learned, it can you have things that can pique your interest and then give you an idea of directions you need to go.
Jog your memory.
Credit bureaus, credit reports, and credit scoring. So anyone heard the term credit bureaus? Okay, I see lots of shaking their heads. A credit bureau is just the place that physically stores the information. It's not paper, it's electronic storage. So the 3 major ones you've probably heard: Equifax or Experian or TransUnion. If you're in this area, those are kind of the 3 major ones. There's actually thousands of credit bureaus, but those are the largest ones. So the important thing too is they store the information. How many credit reports, how many pieces of credit information come every month? 2 billion pieces of credit information come into these storage places every month. So are there chances for mistakes? Yeah, there's lots of chances. So what we need to do is we need to be proactive. We need to make sure that we have the information.
Perfect. Thanks.
You can change things there if the information is correct. A credit report is just a listing of the information they have on you.
Okay, sorry.
That you have used and you've repaid. So a credit report is, how did you use credit? So you may not realize this, but if you miss a payment on your cell phone, or if you miss a payment on your apartment, a lot of times they'll send information to the credit reporting agencies and say, hey, this person has missed some payments there. So again, you should care, because a credit report is the raw data from which they calculate your credit score.
And it's not always correct.
Yeah, it's not always correct. If there are mistakes, your score will be lower and you'll pay more for your loans. I had a student who came to me and he said, Elder Sudweeks, he says, I've got a problem with my credit report. He says, I have the same name as my dad, and I've got a lot of his information on my credit report. I said, how old are you? He goes, 23. I says, how much information do you have? He says, I got 21 years of information on it from his dad. I said, I'd probably be too busy to fix that, because wouldn't hurt him. But if you find
Unless
problems,
his dad has bad credit.
yeah, unless his dad has bad credit. But you need to look this and make sure it's correct. And in the skills development problems, it gives you ways that you can correct. You can report on problems. Then what's a credit score? It's just a measure of your credit worthiness. Just like in this class, we'll give A, B, C's, and D's. A credit score is just a measure of your grade on how well you manage credit, how well you manage trust.
And when you have a higher credit score, they're willing to loan you money at a lower interest rate. When you have a lower credit score, they're going to charge you more for interest because you're more of a risk.
Sister Sedgwick and I put this chart together too. It's credit scores for a credit card, personal loan, auto loan, and mortgage loan. Notice the difference here. The highest credit score for a credit card paid 20%. The lowest credit score paid 39%. On a $50,000 loan that you've repaid over 5 years, the difference was $34,000 in interest.
That's over half.
Notice a 30-year fixed loan, the highest score, the lowest score, the difference was $176,000 more in interest.
So you're going to pay more if you have a low score.
Yeah. So realize.
So we're trying to get our scores up.
Now question, why is these two loans a lot lower interest rate and these are a lot higher? What's the difference? Yeah, they're what's called secured because they can always come back and take your car back.
Or your house.
Or they can come back and take your house back if you don't pay them. So banks will give you a lower interest rate for secured loans.
But like a credit card, they can cancel your card, but it'll be hard for them to get their money back.
Yeah. So 75% of our mortgage loans are sorted on credit scores, the most common being FICO. So FICO is kind of the gold standard in credit scoring. So I'd like each of you to get a FICO credit score if you can, and we'll show you how. So again, realize the cost. 60-month, $50,000 car loan, $30,000. So is it important to keep your credit score high? The answer is yes. Sorry.
That's
Apologize.
okay. That's okay. It's okay.
You may have to do this because I'm on the side. So what is a FICO score? It's just, they're one of the credit reporting agencies, but they're the biggest one, and they're the ones that have done it the longest. So if you have a FICO score, if you have a credit score, you need to understand how is your score calculated. So the first thing is your payment history. 35% of your FICO score is how well have you paid your bills on time.
And so if you don't pay your bills on time, it will ding your score and it will be reported to the credit agency every time you miss a payment.
Yeah.
It's reported to the credit bureau and that will lower your score.
The second thing is how much do you owe? And it's not the dollar amount that you have owed, it's the percentage of your available limit. You'll notice on your credit card it'll say your credit limit is $1,000. Now if you use $100 every month, how much of your credit limit are you using? Yeah, 10%. $100 divided by 1,000. So generally they like your usage to be somewhere between less than 15%. But if you've got a credit limit of $1,000 and you're using $800 every month, does that show good use or bad use of credit? It shows bad use, and so you're going to have a much lower score.
Or you could try to up your credit limit. You could ask the credit card company to give you a higher limit if you're spending up closer to the limit. And if they raise your limit because you've been on time and you're a reliable person that will pay their credit card every month, they'll raise your limit, and then that will actually help your credit score.
That will help your credit score. Length of credit, how long have your account's been opened? That has an impact. The longer your accounts have been open, the better it looks on your score.
So we've had one credit card with United that we've had since, well, you used to have another credit card, but we've had it like probably at least 40 years.
Yeah. So that works good.
It helps.
And then any new credit. If they see you're opening new credit cards, 2 or 3 new credit cards or 1 or 2, then that has an impact there. And they say, well, if you're opening new credit, that's probably not a good idea.
So you know how sometimes you'll go to a store and they'll say, oh, you can save 20% if you open a new credit card with us today. And then you save the 20%, and then you have another credit card, which is going to ding your credit score, because they always pull your report when it dings.
They think about giving you a new credit card.
When they think about giving you a new credit card, they pulls your thing, and then it's a hard pull, and then it dings your credit score, and it makes it go down.
So I have a United card and a Costco card.
And a Sam's Club. We both have Sam's, but I
guess I have 3 then.
I have my Wells Fargo card.
Okay.
So I have 4, but my credit score is higher than his. Just so you know.
She rubs it in every time we teach.
And I haven't had a job for over 40 years.
And then the last thing, but that also says something too about the importance of keeping each other when you get married, helping each other. I like this. I saw this quote here. It was about when you get married. It says most couples split every bill 50-50 and stay broke together. Wealth building couples use this secret: live on one income, save the other, and invest it in assets. While others are arguing over Netflix, they're building a legacy. And so it's really important that we work together, that we work as one, that we make sure our spouses have. What's the odds me dying before Sister Sudwick's does? 85%. So do we got to make sure that both people understand it? Both people have good credit. Both people understand the financing side. And then types of credit. Do you have a healthy mix? Avoid finance companies. Anyone heard of a term, payday loans? Hopefully you never hear of it and you never use it.
But
it's the worst type of lending. It's very similar to that 5-6 loan in the Philippines. But stay away from those things. So if you have all clothing cards or you have all gas cards, now just be careful on your mix. How about marriage considerations? How about when you get married? Does that have an impact? Guess what? When you get married, it doesn't impact your credit score.
Yeah, I have a higher one.
So what you do, you add your spouse as a joint account holder, and that way credit's established for both of you. And again, what we want to do is we want to build each other up.